Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups, brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes driving markets at the moment. So there'll be both technical analysis themes as well as, of course, fundamentals. Whilst I just let you have a look at the disclaimer, this week, for the next 30, 40 minutes or so, we'll go through a couple of those themes actually that we've talked about. One of them we've talked about already over the last few weeks, this breadth in the stock markets and the narrow breadth, if you like, primarily driven by the mega cap tech stocks. We'll also look at this theme around the broad, big divergence between what markets are pricing in for the Fed and what is sort of happening in the economy and what even Fed Chair Powell said last week. So a big divergence there, and we'll just briefly touch upon that before then looking at the equity markets and some of the technicals that we always do in the S&P 500, the Dow and the NASDAQ. We'll then just take a quick look back at the last week's main events, main bigger risk events. Obviously, it was a packed week, and it is a busy week as well this week. But last week, of course, we'll review Eurozone inflation, the ECB meeting, and of course, the Fed FOMC meeting, as well as Friday's non-farm payroll. We'll look back at those connected currencies. So euro dollar, we'll look at the DXY index as well, and then hopefully touch upon gold in amongst that. Then we'll focus on this week's key events, primarily being US CPI data, the inflation data on Wednesday, and then we have the Bank of England meeting on Thursday. So we'll look at cable, that's sterling against the dollar on the technicals there. This week, well, firstly, we always like to go to this chart, which is basically showing you on the left-hand side, that's last week's year-to-date performance for the dollar against its peers. And then the right-hand side is a snip I just took of where we are currently. We can see, obviously, European currency still doing well. Sterling with its breakout towards, well, 127 now. So through 126, held above that weekly close. We'll touch upon that in a few minutes, but the weekly close above 124.47 was really key for more upside, and we're seeing that now 126.62, I think, the latest. So sterling strength, really interesting, and then obviously essentially down to being the Bank of England obviously being a more hawkish bank now, as well as the ECB, of course, and then the Swiss SNB will probably follow the ECB as well. So those three banks, those three currencies really standing out. And then we've got the yen as the big underperformer, sort of pulling back slightly from, you can see last week, but still then the Aussie and the Kiwi pushing to the upside more recently, obviously with some of the rate decisions there, especially in the RBA. So that making up some ground. On the dollar, you can see pretty flat year to date now. We're both down 2.5% or so or more, but now back to flat. So interesting there. That move in the Antipodeans, if you like, but the yen still struggling, even though it has made some slight gains over the last week or so. Markets generally then quite quiet at the moment. Actually, marginal gains really seen in European equities. Slow starts to the week. Of course, there's a UK market closure, obviously, because of the bank holiday here in London. APAC stocks positive, led by Aussie shares. Weekend news flow has been quite limited, really. Focus on the US fiscal drama slightly. So Treasury Secretary Yellen warned the saga could bring economic catastrophe, while Biden is set to meet the Republicans tomorrow. We've sort of briefly mentioned the fiscal dramas, if you like, in passing only at the moment. We kind of think this will get much worse, and it always kind of gets to sort of the brink, the edge, before then heads get banged together and something is resolved. So we're sort of not there yet, and then we probably get more noisy before we get that resolution, of course. Today's focus probably be the SLOOS, which is a new acronym for me anyway, for us here, but it's the Fed's Senior Loan Officer Opinion Survey. We'll touch upon that later on, but it's could make for interesting reading. Of course, because of the banking sector tensions, they eased slightly on Friday, but still will be evident. And Fed Chair Powell, of course, said last week that it will already highlight this report about these tightening credit conditions. Just touching on those couple of themes then, I said last week, and I've said it previous few weeks actually, we highlighted about this small number of tech companies which are driving an ever increasing share of US stock market gains. And that has, of course, prompted concerns among investors about the sustainability of the rally that we've seen. Goldman Sachs now, obviously big US investment bank, that has come out with a note very recently just saying that the big tech, so Apple, Amazon, Alphabet, Google, Meta, Microsoft, they've collectively risen 29%, outperforming the S&P by 23%. And they say these stocks are now expensive when compared to the rest of the S&P 500. They trade at a PE of around 25 times, so a near 50% premium versus its other index peers. So the question is, of course, is that premium justified? And I think last time we said big tech, has benefited from obviously the Fed nearing the end of its interest rate rises. There's obviously this belief that the sector would be insulated from any economic slowdown. And then we've had, of course, the general enthusiasm over AI, generative artificial intelligence. We also mentioned about positioning. That's played a large part, really, because long-only funds have basically been rebuilding their positions after selling big amounts of tech stocks last year. But Goldman, they warned that if the economy improves and potentially we get slightly more rate increases than certainly the market expects, then this outperformance by big tech may slow. And then on the flip side, they say if there is a recession, these stocks could be vulnerable as they are popular in hedge fund portfolios that we've mentioned, and they've been loading up on them because they were underweight these big tech stocks. So just something to bear in mind. So quite interesting, still going on this narrow breadth driving the market. And when we see all these big gains, we need to look at that kind of issue, and whether the breadth is obviously still very narrow or whether potentially it could widen, and then we break out of some of these current ranges we're seeing in the major stock market indices. The other theme I wanted to touch on is kind of this issue, something must give. So it's yet again, we have these two opposing views. We know that corporate America is in much better shape than many had thought, essentially, as the US consumer is far more robust. The job market, we saw that on Friday, remains obdurately healthy, but remember that is a lagging indicator. And then we've had Powell obviously stress that it would take some time for inflation to return to 2%, and he kind of dismissed hopes that interest rate cuts could be on the horizon. And we'll go into more depth around the FOMC just shortly. But the other side of this coin is that bond markets are betting the Fed will pivot. So that's not even pausing, but that's cutting rates very soon. And this sort of divergent views, they've been growing for some time, but really now it's coming to a head. The gap is now its widest it has been after last week's rate hike by the Fed. And that's because from now until January, the Fed funds futures, they price in around 25 basis point rate cuts. So that's over the next 6 Fed meetings. Critical to this idea, well, its inflation will come down very swiftly, come under control. And that's been hastened, of course, by the banking sector stress that we've seen. And there are other measures, of course, too, like the deeply inverted yield curve. Also, we've had the ISM surveys, more leading indicators, if you like, pointing to recession, while commodity prices, oil, certainly have been falling recently. And that all suggests this lack of global demand. So another interesting conundrum, if you like. We've had this not so long ago with the Fed saying one thing, the market's betting on the on rate cuts, and at that point in time, a few months ago, the market came round to the Fed's idea. And if you remember, that's before the banking crisis, when we started to price in 5.5%, even 6% sort of terminal rate in the Fed funds. Now we're at 5%. That's seen at the end. And then cuts, as I say, all next year. Sorry, all this year, and quite quickly. So, yeah, just something will change in this dynamic. It needs to change because that divergence, the difference is very wide, widest it's been. And really, then, if you think about, if you look at some of the other markets, say Treasury bonds and US Treasuries, then the 10-year US Treasury, which is obviously the benchmark, really, that's back to really to where we were last year. And then the S&P 500, that's a wide range, but similar again. We're sort of back to where we were last year. So market's slightly unsure, but at some point this sort of interesting divergence will need to change. Okay, just looking at equities on a technical basis. Just let me just pull up a couple of charts. Just bear with me, actually, because I'll just show you the 10-year and what I was meaning by where we are back to sort of last year. So you can see sort of mid-June, we're at sort of 3.5% or so. Last year, this is, we've tracked up. You can see sort of for the 10-year up to sort of 4.33 there, but then fallen, obviously, and we're back to where we were mid-June. Same with the S&P 500. If we go back, you can see, where are we? Date now is the 8th. This is the 9th of May, and we're pretty much unchanged, quite remarkably, but sort of tracked in this range. So really interesting after all this volatility, and we're sort of unchanged on, well, going back a year. As for equities themselves, as I said on Friday, we had well, US regional bank shares, and as well Apple actually led a rebound on Friday after quite a strong sell-off on the Thursday, the day before. S&P rose 1.85% Friday. That finished the week slightly lower, 0.9% lower. The tech-heavy NASDAQ, that jumped over 2%, was actually very marginally in the green on the week. Kind of not too sure where that catalyst for calm came in the regional banks. Perhaps it was just really the crowded consensus trade really probably went too far in a way. I don't think there was much else out. For technicals, so the S&P 500, this is the weekly chart. We haven't been able decisively to close, and we've highlighted this quite a few times. But above the 50% point of the 2022 decline, which is at 4155, we haven't quite closed decisively. We did a couple of weeks ago, but not decisively above there. And then obviously you've got this early January year-to-date high. Everybody's looking at it, 4195, sort of 4200 level. That coincides with that gray line there, which is the 100-week moving average at 4,201. You can see, so sort of around a sort of zone of 4,200, big resistance level. Haven't been able to push above it or close actually above it either on a weekly basis. So quite important for us. Still a struggle to get beyond that resistance level. Similarly, NASDAQ, let's have a look at that on a weekly. Sorry, let's just go back and look at the daily just to show you. So yeah, we broke out of this sort of nice ascending channel, if you like. Key for us really on the daily is this falling trend line. Let's just pull it back. You can see from the top there, and we pushed above it, touched it, but it held as then support, and also then last week held on Thursday after that sell-off, and we bounced off that falling trend line support. So that's around, where are we, 44,060, 4,058 or so. So that should probably act as support, and then obviously resistance anywhere towards 4,200. That's the S&P 500. The NASDAQ 100, just go to the weekly first of all. Again, sort of bullish consolidation for us above 12,880. That's the previous January high. You can see, pointed that out quite a lot over the last few weeks. Tracking sideways, probably quite a long time to track sideways for a move higher, but then that strong weekly close a couple of weeks ago, and then even last week, you can see we dipped lower, but then closed near the highs. So for us then, first target above is 13,447. That's the 100-week moving average. Whether we can push up now towards that with the strong weekly couple of closes. And then you've probably got a target upside above that mid-August high from last year, 13,720 possibly, if we can push above here. But the more we track sideways in a range, the more explosive the breakout will be for us. So just bear that in mind, because we could move quite quickly north if we can, if the bulls get their way. Obviously, support is around the 12,880 for us, and you can see that tracking sideways on the daily a lot. Just looking at the Dow as well. Just go to the weekly. Technicals again, can't stress enough that sort of high from January again, August actually, mid-August, but we pushed above, try to push above there. You can see it a number of times, January, November, December, 34,281, big resistance level. And we keep on sort of tapping it, but not being able to push above it. And here you can see that line, the dotted line there, sort of bullish channel again, but now we're just tracking sideways, quite messy really. But we have held sort of the 50-day moving average at 33,086. Now we've just pushed above the 100-day moving average. So sort of possibly going higher, but again, big resistance, 34,281, and we're just sort of slightly messy tracking sideways really. Okay, quick review of last week's main events, which firstly, well, here's the pivot that we talked about actually, just checking out the fact that, yes, those rate hikes, five 25 basis point rate hikes from now up through till January, just beyond January, that meeting, taking us back down to below 4%. That's the implied Fed funds rate, looking at the futures. So just, you can see that move there. Okay, but let's move on to last week now. So firstly, we'll look at Europe, Eurozone inflation. That surprised actually to the upside on the headline number, 7% from 6.9% in March. Core inflation did actually drop marginally to 5.6% from 5.7%. So the core is the blue line. Headline, you can see falling sharply, the black line, although it did pick up slightly, as I said, to 7%. The unexpected increase then results of a bounce back in energy price inflation after the strong negative base effect in March, and slightly higher services price inflation. Similar to then the GDP growth from last week, inflation divergence is across the monetary union, across the region, is quite high. That kind of reflects different government energy price caps, subsidies, and kind of pass-throughs from wholesale to retail energy prices. Looking ahead, inflation developments in the Eurozone probably be determined by two rather opposing forces, really. On the one hand, negative base effects from energy and food prices. And then on the other hand, we still have high selling price expectations in services, as well as wage increases, which are likely to fuel underlying core inflationary pressures. So expect really to see that headline probably falling still, the pickup to 7%, probably an anomaly, and we'll see that falling again, whereas core inflation is still expected to remain sticky around that 5% mark. Okay, that's inflation. Also, just wanted to touch on this survey. Interesting, we're getting, because of the banking crisis, I mentioned that American survey out today, and then in Europe, the equivalent kind of is the bank lending survey. And you can see, yeah, this big drop, massive drop, really. Demand for loans falling the most since sort of 08. So back to the GFC sort of levels in bank lending in the Eurozone. And then that relates obviously to the ECB and What happened there? This is just a chart actually just comparing. Look, you can see the ECB with the Bank of England with the Fed. So ECB certainly not raising as aggressively as those other two central banks, with potentially more to come. ECB, as expected, they stepped down actually to a smaller 25 basis point rate hike pace from the 50 basis points unveiled in March. That brought the deposit rate to 3.25%. So while recent data has confirmed underlying inflationary pressures remain sticky, especially for core, there's still weak credit growth. And the latest results of that bank lending survey we just talked about have indicated that the rate hikes so far are clearly leaving some stress on the financial sector of the economy. So for the ECB, then forward guidance for more tightening didn't make it back to the statement, but there was this new emphasis on what they said was forceful transmission of past rate increases, which suggested the ECB was shifting slightly to a wait and see mode. So that was in the statement. And then this was balanced actually by a decision to fully end bond purchases, the APP, it's known as reinvestments from July onwards, which is a probable concession to the hawks on the governing council at the ECB. That was the initial sort of take on events from the statement, but then President Lagarde in the press conference was careful really to set the record straight. And if the statement contained no indication about future rate hikes, then her press conference certainly was dotted with quite a lot of hints about more tightening being on the cards, subject to incoming data. So Lagarde, she stressed that the bank has more ground to cover, is not pausing, and she emphasized certainly that the inflation outlook continues to be too high for too long. Use those words again, and that really kept the door open for further rate hikes. Interestingly, I think it was later revealed actually that the kind of ECB sources story, we always look out for that after the press conference. They revealed that a deal had been done between the hawks and the doves to go ahead with this slower pace of rate hikes, but then ending the bond buying program, and then President Lagarde really pushing the envelope about there being more hikes in the pipeline, really. If we just look at euro dollar then on a technical basis, which is here on the weekly, you can see, well, daily, let's just go to the daily. So actually, just bear with me 1 second, just highlight this. So from last week, you can see the weekly candle there, hopefully, which is a near perfect doji. So we closed on the same level pretty much. Let's have a look. Opened at 110.24, closed at 110.17. This is, remember, in a week of Eurozone CPI and the ECB. So really pretty much unchanged, quite exceptional really, with those major risk events. And right in the middle of the sort of range, the high of 110.92, the low of 109.41. So interesting weekly candle, indecision really, but still with probably a bullish bias for us. We just drop down then to daily. Near-term momentum really slightly neutral, but sort of, as I say, with a upside bias. Support is on dips towards sort of 109.75, 110.25, but a push above potentially 111. We've struggled there. You can see quite a few occasions, but still this sort of near-term trend line at least still looks to be intact. Whenever we drop below there, you can see a couple of times over the last few days, buyers have stepped in and we've pushed back into the green on a closing basis, which is quite important. So still there, bias for higher prices for us, unless we decisively break down probably through that trend line support. And then, well, I've got a dotted line on here, which goes back to 109.42, yeah, which is the halfway point of this decline. So that could offer some support as well, which you can see has sort of happened in the last few weeks as well. So that's euro dollar for us, upside bias really, but really need to break above these recent highs at 110.91, 110.92 area, which has proven a struggle. Okay, on to the Fed. Just bear with me 1 second. Before we get on to non-farm payrolls, the Fed, obviously, they raised rates by 25 basis points. You can see here 5% to 5.25%. Job market still robust. We'll look at that in more detail shortly. Unemployment low, inflation still elevated. But then at the same time, the recent banking stress did result in tighter credit conditions. We'll see that today in that survey, of which then the impact still remains uncertain. And that kind of brought about a slightly more neutral policy guidance. The committee no longer formally anticipates some additional policy tightening, but it doesn't rule it out either. And then quoting again, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. In practice, then, what does it mean? Well, the Fed, at least temporarily, produced a downshift in forward guidance, but then avoided pre-committing to a definite pause, really deferring to incoming data and being data dependent. But as then have to say, as we've mentioned, markets have gone further. They've called an end to this now. And Chair Powell then batted against that, of course, or he batted against the idea of a definite pause during a press conference, pushbacks against the idea of rate hikes by the end of the year, referring to expectations of inflation to decline only slowly. So if you remember this idea of disinflation, which he did talk about, and markets got excited, then he sort of pushed back against that. But then, as we've said, markets doubled down quite aggressively, and then pricing in, obviously, the series of rate cuts for this year. If we look at the DXY, it's kind of a sort of euro dollar turned on its head. If you remember the DXY, 6 currencies, euro by far the biggest weighting in this index, around 56, 57% or so. So you can see, still sort of equivalent to that 110.90 zone is sort of 182 on the DXY. That long-term support from back in, well, the year-to-date low actually back in February, tested a few times, you can see, broke out of that sort of descending channel really. It's probably a wider channel now, but still prices looking towards testing that 182 level on the DXY. Okay, that's the Fed and the main events from last week. We'll just touch upon NFP actually very briefly. Obviously, the labour market report on Friday. Here's a brief review with all the big numbers anyway. Hopefully, these prove useful to you, these graphics. So you've got the headline. So April labour report showed really quite strong headline number, but then these major revisions really sort of clouding the outlook slightly. Headline 253 against 185 consensus, 149 net thousand downward revisions to the past couple of months, spread pretty evenly really between February and March. Probably for markets then, the most important number was the higher than expected wage growth, plus 0.5% month on month versus 0.3% expected. The year on year rose to 4.4%, above forecast, 0.2 above the forecast, 4.2, I think it was. And that actually follows 3 straight 0.3% month on month prints, and will really keep some of the more hawkish Fed officials nervous about inflationary pressures coming into the labour market. The household survey then showed a surprise decline in the unemployment rate from 3.5% to 3.4%. That matched the cycle lows seen in January, and then that 54-year low from 1969. So really interesting report. Sort of one side, some economists saying about this rise in the US wage sum. So that's the product of employment and wage gains. Showed really the nominal engine behind the US economy remains on a strong footing. Then that leaves the Fed, they say, really in a tough spot where they have to decide on either keeping rates higher for longer at current contractionary levels, or even delivering an additional rate hike. Others on the other side, I guess, flip side, it's difficult to come up with kind of a firm conclusion about these numbers. especially with those revisions. Does that mean the 253,000 that gets revised next month? But really, the point about the labour market potentially is it is this lagging indicator, and we do then tend to get some contradictory signals at major turning points in the economy. Certainly, there's leading indicators. We kind of mentioned some of those, but the US economy's not doing that as well as sort of this lagging NFP data points to. And certainly then bank tightening lending standards. We talked about those over the last few weeks because of the banking crisis. Then they kind of always result in unemployment moving higher. And that is certainly what the Fed expects, to sort of 4.5%, I think, towards the end of the year, from then this 3.5%, 3.4% number. So will be interesting to see how that really, well, what really happens there with that unemployment rate as these tightening and lending standards kick in, and of course then this lag in a way from the most aggressive, obviously, policy tightening cycle that we've seen in living memory, really. So yeah, banks really then, just to touch upon that, will be pulling in credit lines. That turns struggling businesses into failing businesses potentially, and then unemployment climbs. So just something to watch out for potentially. We've said about that unemployment being a key number then going forward in this NFP number, as well as potentially these revisions to some of the headline numbers. We were going to touch on gold, which I know everybody likes to trade and look at. Really interesting last week. I've actually got a weekly chart, and I put this in the daily commentary that we put up on the website. Hopefully some of you guys read that, and it proves useful. We have a chart of the day, and I think I put in gold there on Friday ahead of the NFP data. You can see, and I put the weekly chart because I put in that this sort of upward channel, of course. So last week we got, well, pretty close to the all-time high. We touched 2,062 on Thursday. If we just have a look at that spike high, well, 2067 actually on Thursday. Highest intraday level since March 2022. Obviously on this potential Fed pause, as well as then concerns about recession, renewed talk about the banking sector, really underpinning investor demand for gold. But then we had, if we look at the daily, we had quite a sharp fall on Friday after the strong jobs data, really pushing treasury yields higher. Gold dropped nearly 2% actually on the day, and then tested again that 2,000 level before we bounce back again, recovering now to 2024. You can see 2024. So current price. Interesting, gold. The World Gold Council actually said bullion demand from central banks actually slowed purchases sharply in the first quarter. But China stood out as an active buyer, adding to their gold reserves for a 6th straight month in April. We've also got strong jewelry demand, actually, just looking at some of these wider factors. That's expected to pick up as China reopens, and that kind of continues to further support potential upside in the gold. I guess technically that all-time high is at 2075 from back in August 2020, and we can see if we just pull back, actually we've obviously rallied from 1614 in early November up to sort of the around 2000 level, then struggled at there initially, and then after we pushed above there, obviously in March, we've stayed above that level just about. You can see in the last few months or so, as the Fed obviously has got closer, at least to, or markets thinking it's got closer to the end of its rate hike cycle. More recently, we've rallied around or more than 10% actually since early March. And concerns, obviously, then the banking sector concerns kicking in, falling dollar, treasury yields falling as well. Certainly then going forward, interesting candle really from Thursday. Possible, bearishly looking candle. We obviously moved down Friday, but Fed policy over the medium term will be key. Whether cuts, as I've mentioned a lot now, whether their market's got ahead of himself too much, and potentially with inflation falling, but still sort of potentially remaining around, say, 4%. through the summer. That's still more than double the target rate. So yeah, just something to think about with gold and Fed policy being instrumental. Okay, then this week, moving on to the main events, we've got US CPI data. Firstly, that comes up on Wednesday. Consensus, again, little graphic here. Headline consumer prices expected to rise 0.4% in April, so accelerating from 0.1% in March, while the annual measure is seen ticking up 0.2 to 5.2%. That's the headline. Core rate expected to rise 0.3%. So moderating slightly from that 0.4% month on month in March, while the annual rate of core inflation seen unchanged at 5.6%. Core goods inflation will increase with higher used auto prices from the first quarter showing up in CPI this month. That's what's expected, while inflation in other goods categories is expected to remain flat. Then on the other side, if you remember, always break this down then into services inflation. That will remain high, with shelter inflation showing a slight decline actually in April, but really not expected to be to meaningfully decline until later in the summer. Kind of all points to a reading which would remain, as we've said, uncomfortably high for most on the Fed. But then it's kind of consistent with very gradual disinflation this year. So falling prices, falling price pressures, disinflation once those shelter costs roll over, expected to do so more significantly through the year. Okay, that's US CPI. Just touching on what else there is from this week in the US. I mentioned that survey data. So that's the Fed's Senior Loan Officer Opinion Survey. Is out shortly, actually. Today will just show, as we mentioned, lending standards at mid-sized banks tightened in the latest period. Fed Chair Powell already mentioned that last week. And the survey is prepared actually in advance of the Fed's policy meeting, so officials can use it in their deliberations. Yeah, Powell argued that given the recent stresses in the banking sector, then the Fed might not need to raise rates as high as it would have traditionally. Sort of saw that as around a 25 basis point, possible 50 basis point equivalent. So he emphasized that the impact was still unclear, but making it really difficult for officials to determine when the policy rate had achieved this sufficiently restrictive stance. Okay, that's in the US. Then in the UK, of course, we get the Bank of England meeting. Again, another graphic with the main numbers to check out. You can see expectations are for the bank to deliver a 25 basis point rate hike. That would move the base rate up to 4.5%. The prior meeting, actually in March, if we think about that, it saw a 7-2 vote in favor of a 25 basis point hike, then with two dovish dissenters. I think that's probably pretty much what's going to be expected this time as well. And then, sorry, just stepping back to March, then the MPC opted to keep forward guidance on rates, which notes that if there was more evidence of persistent price pressures, then further tightening would be required. Since that time then, since March, the data, as I've put here, is kind of leaned hawkishly. We've had still double digits year-on-year CPI, 10.1%. So a very, very difficult situation for the MPC. The core rate as well at 6.2% against the MPC projection of 5.8%. Labour market headline earnings growth, that's still strong, 6.6%, so 1/10 higher. And then other data, sort of flat line, month-on-month GDP, and then survey data showed actually an increase in the UK composite metric, really fueled by the strong services sector. So taking that all into account, then definitely further action from the MPC is expected. I think Governor Bailey, late March, reminded markets actually that more tightening would be required if signs of persistent inflationary pressures become evident, with the MPC's focus really on returning inflation to target. This time then, what will we be focusing on in the market? Focusing on is essentially whether the MPC make any alterations to forward guidance, really to indicate the possibility of a pause given the likes of chief economist Pill has continued to remind markets that I think he said there's a lot of policy in the pipeline still to come through. But as it stands, markets still then pricing in terminal rate, I think above 4.75%. So that would imply another 25 basis point hike beyond this week. We also get macro projections, actually, which most economists are anticipating an upgrade to near-term growth and then a downgrade to near-term inflation, whilst over the medium-term inflation will be materially below 2%. Remember that in 2024, 2025. So any sort of big deviations from those expectations will be important for markets going forward. I've just got another couple of graphics. So you see, here's the CPI data in the UK, still very punchy. You can see headline above 10%, although it was coming down, and then core obviously still sticky around sort of above 6% or so. That's inflation. That's the real issue for the MPC. And then this chart just shows you the pink line is the benchmark rate sort of climbing, but still sort of 4% below 5%, but potentially getting up towards that level, 4.75% at the moment. And then you've got CPI obviously tacked on there, coming down, but still above or so 10%. Okay, just quickly looking at cable before we wrap it up. And in fact, euro sterling we'll look at as well. So you can see really just going to the monthly chart, you can see actually we're in the 9th straight week of gains for sterling against the dollar. That's, I think, not been seen since around 2003. And a 126 handle for the first time in close to a year, I think. So have been highlighting over the last few weeks, really need to close above 124.47. I mentioned that earlier on. That would be key for more upside, and that's basically what we got. Look, you can see a couple of weeks ago, decent close above there, and then we pushed further up towards and above 126. Where are we? 126.57 now. So, bullish momentum still sort of gives us impetus to get towards that 100-week moving average, probably around 127.08. That is, so potential resistance there for more upside. If we just drop to the daily, you can see, 124.47 there, sort of oscillated around then pushed above it and look pretty good now for more upside. That's a very strong sort of support level, and then above that, probably these recent highs around 125, 126 level, probably you call it for initial support. That's on cable. Just want to look at euro sterling as well. Always can be interesting to trade. Kind of stuck in this range. You can see between sort of, where are we? 87. Roughly or so. I know we poked above there, but not for too long. And then above there, sort of 80, 89. So 80, spot 87 to spot 89, trading between there for quite some time. You can see tapped it and then fell below, and now we're at the bottom of that range. And also the 200-day moving average, which is that black line. We sort of didn't tap it, but got close end of last year and then rebounded off that. So whether then we rebound off that, which is sort of keeping in this range and moving back up towards 88 or not. Interesting level, interesting sort of area for euro sterling traders playing the range or hanging around there before possible break lower, but that would be out of what has been this sort of range for most of this year. We then probably go back towards that lower range, if you like, down towards 86. So interesting times for sterling, of course, with the Bank of England meeting on Thursday. Okay, hope that's proved useful to everyone. Really good to have you on the call, and we will be back same time next week. Okay, take care out there.